consider three types of share issues. Now, what is EPS? The basic EPS and the formula we already have discussed. Weighted average number of shares we already have discussed. Now, let's see. What type of shares do we have? We say full market price, FMP, full market price share, which means that a company might have a share which has a face value, which is also called the nominal value. Let's suppose your face value is $1 and your market value is $5. So this is called market value. When you issue the share at $5, it is called full market price. So you are actually selling the share at full market price. In rights issue, in bonus issue, you give it for zero. In bonus issue, you don't charge anything. You just give away shares as a bonus. In rights issue, you give shares at a discount, probably 20-25% discount, and you are issuing shares at $4. Now, these three numbers are going to make impact, okay? What is the impact? And that is kind of financial management issue I'm going to discuss here in detail. So three scenarios are with us. As a company, we can issue shares either for free, we give them as bonus, or we charge the full market price. Market price is 5. Now, we already have existing shares, 5 million shares issued. And now we need more capital, and we have decided to issue 1 million more shares, additional shares. So because my shares are already in the market, they have an established market price of $5. And we said that we are going to issue 1 million more shares at $5, full market price, or we can decide to offer them as a discount, $4. And this usually it is done to existing shareholders. This is not done for the new ones. Okay, this is a favor. This is usually given to the existing shareholders. Now, here it says, if you have these numbers, like I said that market price is $5, and I'm issuing them at 5, I'm issuing it at 0, or I'm issuing it at 4. Use weighted average method, which we just discussed before, straightforward. Bonus issue, apply retrospectively bonus fraction. Retrospective bonus fraction. What is bonus fraction? I'm going to discuss that. Or treat it as a full market price issue followed by a bonus issue. So in right issue case, you consider that it is a full market price issue, and then you are giving some part as bonus. Okay. And how it is going to impact the EPS. Where an entity, now this is the same thing, the same diagram, that if the entity has issued shares at the current market price, it will have received a 2 price for its shares. It is receiving 2 price of the share. Market is 5, you are selling for 5. It will therefore be expected to generate a return on these shares in the form of increased profits, because you have issued a share, you have received $5, you will invest that $5, and and you expect that profits will increase as a result of issuing the shares. Because I'm getting cash, I'm going to invest it, and that because of that investment, if my number of shares before was 100 and my profit was, let's suppose, X, now I'm issued 1 more share, but my profit will also increase, because I will invest this money. So on one side, my number of shares are increasing, and the other hand, my profit is increasing, which somehow will help to keep the EPS under control. However, if the shares issue occurred partway through the year, the entity will only be expected to generate extra earnings for the time during which it had use of the additional funds. Now, what happens? We had, like, let's suppose we are keeping a simple number, 1 million shares in the beginning. Then in 6 months, we issued 100,000 more shares. End of the year, we have 1.1 million shares. Now, these funds we received, but these funds, they only generated profit for 6 months. So this scenario is going to have a slightly negative impact on EPS. If you consider 1.1 million shares, then your EPS is supposed to go down, because you are taking the full 100,000, but actually you are using 100,000 for only 6 months. So what I should be doing, I should be saying that I have 1 million and 50,000 shares. This 100K shares are not for the full 12 months. The earnings which they bring is only for 6 months. So I can consider that either it is 100,000 shares for 6 months, or I can say that it is 50,000 shares for 12 months. So that's why we said that you have to multiply 1.1 million times 6 by 12, because it remained only for 6 by 12 month of period. So how would I would say 1 million into 12 by 12, and then 100,000 into 6 by 12. And 100,000 into 6 by 12 makes me 50, and that gives me 1 million, and I would say 1 million 50. So this is weighted average. And why we are doing it weighted average? Because we are using these funds not for the entire period. If we take it 1.1 million, EPS suddenly will go down, because number of shares you have added full, but profits are not coming for 12 months. Profit are only coming for 6 months. So this is important to understand. As such, the number of shares in issue must be time apportioned. Time apportioned, what I did, like 100,000 into 6 by 12. Illustration, one short example. A company has earnings of $100,000, and year end of 31st December, on 1st October 2002, the company issued 300,000 shares at full market price. Remember, full market price, FMP. In full market price, we use weighted average method. Full market price, like it's not bonus, it's not discounted right issue, it's full market price. The share capital before the share issue was 600,000 shares. 600,000 shares we had, 300,000 we issued again, and we issued them on 1st of October, which means October, November, and December. So I should be considering 3 by 12. So how you would do that? So you had 600,000, which is because then your shares changed. Okay, you had 600K here, then you added 300 further, so this number becomes 900. I'm sorry, if you added them in somewhere here in October, 300, and you became 900, and this 900 is only for this period, but 600 is for this period. So 600,000 into 9 by 12 gives you 450,000, and this 900,000 into 3 by 12 gives you 225. So you take this number from here to here, and you take this number only, 900,000. By the way, I can use an alternative calculation as well. Like I told you, there are 2 ways of doing it. If I'm doing it, I will take 600K full. I will say 600K, they remain 2 out. So this is like 12 by 12. And then I would say the additional 300,000 which I have, this I will do, say, by 3 by 12. So this becomes 600, and this becomes 1 and 4, 4 and 75, and 75. Answer will remain the same. So they are taking 900,000 into 3 by 12. I'm taking 300,000 into 3 by 12, because they are also taking this 9 by 12. Here I take 12 by 12, because I assume that 600, they remain from the beginning to the end. And then another one, which is 300, it just came for this period. So this period I take 12 months, this period I take 3 by 12. This is my way of doing it. I take 600 and 300 separately. How did they do it? They say from here to here, first 9 months, it was 600. And then the remaining 3 months, it is 900. So they are doing like this: 600 by 9 by 12 and 3 by 12 like this, 900 by 3 by 12. So whether you do like this or you do with my method, it's the same answer you get same. So although on your balance sheet on 31st of December, you might have 900,000 shares in issue, but in EPS calculation, you will only use 675,000. If you have any questions until here, please ask me. No question? Okay. So EPS now, $100,000 was your earning, which was given in the question before, and 675,000 is the weighted average number of shares. 14.8 cents per share is your EPS. Bonus issue of shares. Now that's the second type. First one, full market price. Second one is bonus. And in bonus issue, if you go back, I just want to show you this thing. In bonus issue, you said that you will apply retrospectively, use bonus fraction. So you're going to use bonus fraction and you're going to use it retrospectively in past. Why do we do that? And what is bonus fraction? I'm going to explain now. So, okay. Bonus shares are issued at no consideration, and therefore the company cannot be expected to generate the same return after a bonus issue. I was explaining you that let's suppose you had earnings X and you had 100 shares, and X divided by 100 would be your EPS. But then you decide to give one additional share, but you are giving it for bonus. You are giving it as a bonus. So it means that cash will not come in, and the cash will not be further invested. So your earnings will remain same. Earnings will not increase. Earnings will remain same. Like before it was X over 100. Now it is X over 101. So naturally speaking, there is going to be a negative impact on your EPS because you just gave bonus issues. Now, why do I need to calculate? So what we need to do, we need to somehow, neutralize this impact. For example, you guys are my shareholders. This is me, and you guys are shareholders. And you say, Mr. Ali, you are the manager. How is the business doing? I say business is doing perfectly fine. We've got so much in retained earnings. We've got so much in share premium. We are doing very happily. How much is EPS? EPS is 5. Oh, you've got huge returns in the share premium account. Usually we use share premium account for giving out bonus shares. By the way, share premium account, and it is share capital. So share premium account usually we say debit, share premium, and credit, share capital. So we increase the share capital, which means we increase the number of shares and we decrease the premium. So you guys get the shares in your hand and you walk out without giving any cash. So I had 100,000 shares, or I don't know, 1 million shares. We had 1 million shares. You walked in, you asked how the business is doing. I said business is doing fine. 1 million shares you had. You say, you've got huge reserves in share premium. What are you planning to do with that? I say, I'm planning to give you some bonus to make you guys happy. And you say, that's a good news. And then I give you bonus issues. I issue 200,000 shares in bonus. Then after giving you this thing, in next year, what will happen? My earnings will remain same because you didn't give me any cash. The business performance, the business operation, the business activities, the projects are the same because we did not make any cash investment. So we are making the same X dollar profit, but this time we have 1.2 million shares because 200,000 shares I gave you as bonus. And suddenly the EPS will fall down to 4. And then you come in and start blaming me. Ali, what are you doing? EPS has gone down. I say, see, my profits are same, my operations are same. I'm not doing bad. I'm doing same. The only thing is that I gave you some shares for free, and that has increased the number of shares. If I had given them on cash, then I would have received cash for 200,000 shares. I would have invested that money in some project, and I would have increased my profits. But here, there is no cash coming in, no new investment. So profits will remain X as before, only the number of shares have increased. So this is the impact of bonus issue. And we need to understand it, that when you give bonus issue, possibly your EPS is expected to go down. And then how do we present it so that the shareholders, they do not blame us? Otherwise, they would say they will get panicked that company or business is losing on EPS. They will start selling the shares. So in order to make the EPS comparable year on year, where there has been a bonus issue, it is necessary to restate the prior year EPS. It is necessary to restate the prior year EPS figure. Because last year I told you EPS was 5. This year I'm telling you EPS is 4. But this 5 is based on 1 million shares. This 4 is based on 1.2 million shares. So I cannot change this one, but I need to restate this number. That if the number of shares had been in past 1.2 million, how much my EPS would have been. Okay. And this is done using the reciprocal of the bonus fraction. So there is a word which is called bonus fraction. And then reciprocal of the bonus fraction. Bonus fraction means, like, for example, 1 by 4, or let's call it 2 by 5. And reciprocal means 5 by 2. So reciprocal means when you just switch the sides. So what is bonus fraction? I'm going to explain that as well. Let's see one example. It says that a company has the following assets: earnings and share capital. Assets, example, cash is 100,000 in 2001 and 2. Earnings are 2020. Shares are 201 and up. You see, from 2001 moving to 2002, number of shares have increased. EPS was 10 cents and here 20 cents because you did earnings by shares. So earnings divided by shares, 20,000 divided by 100,000 was 20 cents. 20,000 divided by 200,000, it is 10 cents. Now they're telling us that on 1st January 2002, the company makes a bonus issue on 1-to-1 basis. Now, 1-to-1, so sometimes you say 1-to-1, sometimes you say 1-to-4, sometimes you will say 1-to-6, maybe 1-to-10. What does that mean? When we issue shares, when we issue bonus shares, they have to be in a limited quantity, in a limited number. And then how many of bonus issues we will give? So 1-to-1 means that for every existing 1 share, you will get 1 extra share. 1 for 4, it means that for every 4 existing shares, you will get 1 bonus share. 1 for 6, for every existing 6 shares, you get 1 extra share. So I ask you, how many shares do you have? And you say, I've got 30,000 shares. And I say, okay, 30,000 divided by 6, you will get 5,000 bonus shares. And Joseph, how many shares do you have? Joseph says that, I've got 60,000 shares. So 60,000 divided by 6, Joseph, you will get 10,000 shares. So this is how you proportionate. By the way, 1-to-1 basis is a very dangerous thing, which means if you have got 10,000 shares, you get 10,000 more shares. It is 100% bonus, 100% bonus, which is huge. So they have given, and that's why we can see that the number of shares have gone from 100K to 200K. Because they give 1-on-1 bonus. So for 100,000 existing shares, 100,000 bonus. And there was no cash because it is bonus. And therefore, cash remains same. And earnings are also same. There is no change in earnings and there is no change in the cash. Only the difference is in number of shares. And result, you can see EPS has been shot down from 20 cents to 10 cents. So let's see it like this. And when do we do that, by the way? 1st January. As it stands, it looks like the company has not performed as well in 2002 as it did in 2001. The reason we already understand that you have, in 2001, every share you owned would have earned you 20 cents of profit, whereas this had fallen to 10 cents in 2002. But there is one more thing you should understand. If you see now, so there was one investor, let's suppose we talk about Janish. So Janish was very unhappy. Janish came to us and said, Mr. Ali, last year my EPS was 20 cents and I had 10 cents. This year I have 10 cents. What is happening? I'm worried. I say, Janish, how many shares you had last year? He said, last year I had 5,000 shares and each share was making 0.2. I say, when I gave you bonus, now you have 10,000 shares. Remember, 1 to 1. And each share is making 0.1. So your total earning is the same. If you can multiply 5,000 into 0.2, answer is 1,000. And 10,000 into 0.1, answer is still 1,000. So although that your EPS has gone down, your number of shares have increased. So before you were getting 20 cents on 5,000, now you're getting 10 cents on 10,000. So Janesh, no need to really get worried. We have some explanation for that. So we say, however, following the bonus issue in 2002, for every one share you previously earned in the company, you were issued one further share for free. Therefore, every one share you owned, which you earned 20 cents, you now own 2 shares earning 10 cents. End of the day, 1 share for 20 cents, 2 shares for 10 cents makes the same thing. Therefore, you are no worse off. Are we clear until here?
Yes, sir.
In order for the financial statements to show this, we need to restate the prior year EPS using the reciprocal of the bonus fraction. Now, this is, I can talk to you while we are online, so I can explain you. Or maybe if Janish had come to me, I would have explained to him. But how can I do it? I cannot talk to millions of shareholders individually one-on-one. I already have given, or I have to publish my financial statements on my website where people are seeing the results, and they might not have, they might not know about this thing. They're not technical guys. They will only see that last year it was 0.2, this year it is 0.1. Business is gone. We are not investing. We are going out. So I don't have this opportunity or this, flexibility of explaining this thing to everyone. So I need to put it on my financial statements, because remember, EPS is shown on the financial statements. So I want to restate also on my financial statements so that people don't see this thing. If they see this thing, they should see this one as well. So that communication gap should not be there. So in order for the financial statements to show this, we need to restate the prior year EPS, last year EPS, using the reciprocal of the bonus fraction. Bonus fraction in this case 2 to 1, because for every 1 share you previously owned, now you own 2 shares. Before you had 1, now you have 2. So it is 2 by 1, which means 2 times. Okay, 2 by 1 means twice. The reciprocal of the bonus fraction is therefore 1 by 2. So 2 by 1, and you switch the sides, it becomes 1 by 2. And this 1 by 2 you multiply with this 20 cents. 20 cents into 1 by 2 means 10 cents. Bonus fraction is 2 by 1. 2 by 1. Or let's call it 2 by 1. Because last year there was 1, this year there is 2 shares. And reciprocal of that is 1 by 2. Last year's number of shares. So this actually reflects what? By the way, this reflects what? Let me explain you, because otherwise you might get confused. Let's suppose that your number of shares, and I'm not assuming a number, I'm using an alphabet. Let's suppose, because that will help you understand better. Suppose you have number of shares, your number of shares are X. And you say we are going to give 2 to 5. 2 to 5. Which means that for every 5 existing shares, we are going to give 2 new shares. So you know that after this thing, what will happen? Your new number of shares will be X plus 2 by 5. This is your new number of shares, X plus 2 by 5 of X. Mathematically, this is your new number of shares, X plus 2 by 5 of X. Am I right or wrong? Now let's suppose you had 100,000 shares. And I said, I'm going to give 2 to 5, which means that for every 5 existing shares, I'm going to give 2 new. So new number of shares would be 100,000 plus 2 by 5 into 100,000, which means 20 and 22, 40, 140,000 shares. 140,000 shares. Right? Okay. So then what you do that for bonus fraction, if you now are increasing you're increasing with 2 by 1, which means you are doubling the number of shares. So last year was half of that. So you reciprocal it, you reverse it. If this year, current year, because we have doubled the shares, for every 1 share, we are giving 1 more. So we are actually doubling the shares. So last year it was necessarily half. If I give, 1 to 2, so it means that it would be 3 by 1. So last year it would be 1 by 3. Okay. It is restated this one. So 20 cents into 1 by 2, 10 cents. Effect on EPS of changes in capital structure. Right issue of shares. Now we have done 2 things. One, we said full market value, which was $5, let's suppose. Then we issued bonus share for 0, and now we are going to issue right issue for a discount. Let's suppose shares are issued at $4. So this one we did for weighted average. This one we already have just simply done it, and this is right issue. Now, what is the problem with right issue? Right issue will also have 2 types of problems. One problem will be like weighted average. Right issue might be happening here. So I am getting cash, but I'm getting cash in the middle of the year. So I need to use my weighted average kind of stuff, because I issued shares, 100,000 shares I issued, but I did not issue them at the beginning of the year. I issued them on 1st of October. So I only used the money for 3. Like you remember I said 1 million shares, then 100,000 shares, total 1.1 million. But this 1.1 million did not remain with us for the full year, because 100,000 shares we only had for 3 months. So weighted average concept is there. Understandable. That makes sense. So I need to understand the weighted average thing. And the second issue is that the market price of the share was 5, and I'm giving it at 4. So it means that there is an element of bonus. You remember your market price of the share was $5. So when you get full market value, you offered at 5. When you gave it for 0, you called it bonus, because you gave it for 0. Now you are giving it for $4. So it means that it is not full market value. There is some discount inside. So it means that there is some element of bonus still available. Remember, for bonus, we made adjustment reciprocal multiply the bonus factor, reciprocal multiply with the last year, so that last year share price should be adjusted. For example, if I had 1 million shares and then I'm offering 100,000 more shares, but I'm offering only at $4. So it means that I will get some cash, but there is some free element also. So I will get cash, I understand. I will use this cash and I will increase my earnings. But don't forget that there is a $1 bonus element as well, which means that my EPS still is expected to go down. Just like I said, that bonus issue will decrease your EPS and it would decrease significantly. Like last year you had 0.2 and this year it becomes 0.1. So there was a significant impact on EPS because you gave it for 0. This time you're giving it for 4.